Okay, so I feel like I'm one of the most important people on this panel, because I'm the person that helps you get the money. And without the money, you can't do what? That's right. And I want to start by saying it is the most intrusive process you will ever experience in your life. Why is it intrusive? It's all your information. Somebody has all your business. More than your spouse quite often, more than your family. Y'all be hiding money, credit card accounts. Y'all know how y'all do packages be going to your friend's house. So the first thing we're going to do is we're going to get pre-approved. Now when we're talking about pre-approval, that is where it all begins. We're going to take an application from you. The majority of what we do is done digitally. However, most lenders will meet you or do a Zoom if that's not convenient. The application will require 2 years of residency, 2 years of employment, your assets, your income, and your bank account. So you're going to provide 30 days of pay stubs, 2 years of W-2s if you're not self-employed, and 2 months of bank statements. With that, we're going to take a look at your credit. Now, depending on where you're at, we may make a decision that you're ready to go now, or we may have some work to do. One of the great things about lenders is we understand credit bureau scoring. So we might tell you, you got 6 accounts you got to stop charging on and go pay down. And put them in the freezer. Don't use them anymore. Right? So that's going to be the pre-approval process. Now, there's a difference between pre-qualified and pre-approved. Pre-qualified means that somebody took your word on what you make, how much money you had in the bank. They did not verify any of it and said, based on that, you're ready to go. Yeah, see her face? Y'all see her over here? That's not real. That doesn't mean you're ready to go. What you want is a pre-approval, which means I've taken your application, I've gathered all your information, and I've actually sent it to an underwriter. We are going to question everything you do. We're going to question, if you're a 40-hour employee, why weren't you at work for the last 3 weeks? What were you doing? Because all of that impacts how we calculate your income. Remember, you're asking a lender quite often to give you $500,000, $250,000 on your promise that you're going to repay it. They're going to ask you a lot of questions. Okay? Once you get your application done, you're on step 2. We're going to gather all your loan documents, and that's what we just talked about. W-2s, pay stub, bank statements. We are going to verify everything you give me. I'm going to say that one more time. If you are in that Facebook group that produces W-2s and pay stubs, please don't. We are going to verify everything you give us. Okay? So once we gather your documents, then we start looking at what programs are best for you. A good loan officer is going to say, here's a couple of down payment programs that will work for you, because most down payment assistance programs have income limits or other guidelines. So you've got to figure out the one that's right for you. We're also going to look at what loan program is best for you, whether it's conventional, VA, FHA. Okay, so we're going to explore down payment assistance. What does that look like? What are the good, every down payment assistance program has pros and cons. So we want to go through what's the positive of the program, what's the downside. What's the difference if you come in with your own money versus using one of the programs? Because remember, this is a long-term decision, at least for the first couple of years, right? So we want to make sure that we have you set up for success. Make sense? Yes. All right, you guys with me? Yes. Next, we're going to go to underwriting. Now, you will never meet the underwriter. The underwriter is the person that has the authority to actually lend money on behalf of the company. All they see is the paper. And what does the paper say? Think about your credit report kind of as your background check. How have you been doing? Have you committed any crimes that were recently released? Right? Think about your job history. Doesn't mean you have to be in the same job for 2 years. It just means we're looking for you to have worked for 2 years. Now, if you're changing job every couple of months, that's a little tight, because then we've got an issue with job stability. Make sense? Yeah. So that's what the underwriter is looking at. My job as a loan officer is to actually take the way you've been living your life today and make it acceptable to an underwriter. So my job is to say, so, what happened that you stopped paying everybody 24 months ago and then you got back on track? Well, if you say, I decided not to pay you, that's not what we're going to say. We're going to have a different conversation. You know, I had some catastrophes happen in my life. I had a sick family, and we're going to put it together in a way that makes sense because we're looking for you to be credit worthy. The next step is conditional approval. An underwriter will do one of three things. They can approve your loan, and you'll always have conditions. They can suspend your loan, saying that maybe they need more information to make a decision, or they can just say you're not ready. Very rarely is it you're not ready, unless I've missed something. And I'm human and I've missed stuff before. But typically is you're good to go, or can you go get me some additional information so I can make a decision? That's what the underwriter does. And they issue a conditional approval. Anytime you have your initial underwritten approval, you will always have things that you need to supply before you can conclude the transaction. Last, once we have your conditional approval, we send you out with one of these wonderful realtors so that you're able to start shopping for a home. Okay, so my job is the money. What are the things that you need to think about? If you are paying $1,800 a month rent now, and at the end of the month you have $50 left in your bank account, do not ask me for a $2,700 mortgage. Do not tell me you're going to stop eating out, you're never going to go to the show, next time you're going to forego Beyonce concerts, tickets, because none of that's true. The best thing you can do to prepare for homeownership is know what you truly can afford. Start there. We work magic with numbers. For example, we use your gross income. Your income before you see FICA, SAM, COLA, anything else. Is that what you bring home? Do you see how we can set you up for failure? We also only use the debts that appear on your credit report. So we're not talking about car gas, car insurance, groceries. You all know what groceries look like these days. We're not talking about child care, Pampers, party money, hair, nails. We're not talking about any of that. So do you see how we can set you up to fail? So the best thing you can do is come in with what you can afford. And understand that if you're a first-time homebuyer, you need to get into the game. Your goal is to get into the game. Start somewhere. Your first home may not be the Taj Mahal. It took me 4 homes till I actually got a home that I thought, okay, I've arrived. But every time I took the equity from the prior home, used it to get the next home. And that's what you have to do. So yeah, you might be over on East Nellis to begin with. Don't shake your head. No, I'm just saying you might not be in the house that you want. But keep in mind, you're paying somebody an apartment that you get no benefit from that doesn't even come in payment. At least this is yours. Know how much you can afford to spend. Be realistic about what that looks like. If you have a 2-bedroom apartment and you're making well, you might want a 3-bedroom house. There's no reason for you to need a 6-bedroom house and you got the same number of family members. Be realistic. And the clearer you are about what you can do and how you can do it, the easier it makes our process.